Yeah, good evening to all of you. In case if you happen to be in a different time zone, maybe a good afternoon or good morning. So, I'm Amit Parak. So I've been into corporate banking, equity research, into corporate finance. I've taught finance, accountancy, cost accounting, some amount of risk management. So in a sense, almost everything that would come within the finance domain, directly or indirectly related to it. Uh, I have written various exams, and as you would see it, I cleared my CFA. I'm also a qualified chartered accountant, company secretary. I aced my FRM, and I did my PGDM from IIM Ahmedabad. So I believe cracking exams was one of my positive points, one of my strengths, and I believe I can help you guys do that. So I would expect, or I would assume that all of you happen to be writing your CFA Level 1 in December. Is it so? Am I right when I assume that all of you would be writing your CFA exams? Okay, great, great. Okay, wonderful. So how's it going? Feeling nervous? Okay, okay, just started. Okay, okay. No issues, no issues. I think you guys have time, and if I were to just share my example, though I'm not too sure whether that would be the best of examples to set. Well, I started around a week before the exam, though a caveat, I think I just had a solid enough background in finance. So if some of you have already done your MBA in finance, then maybe you could afford to start 10 days before the exam. But if you are somebody who's new to finance, I think it's time that you start. In fact, by now you should be well into the training mode. So nevertheless, let me just try and set the agenda for today's session. So basically what I would do is look at some of the important topics within the domains that I handle. So let us see. So before I do that, I believe you have around 20 days around left. So and how should you go about the next 20 days of preparation, and let's say 2-3 days before the exam, what should be your preparation like? Okay, so I mean that is something that I would talk a little about. So I think for people who are well through the preparation, have already had a look at the material, have gone through it, have practiced enough questions, I think best served if you split the next 20 days in terms of the number of days that you're going to give to each of the topics. I think that should be well cast in stone. So in the next 20 days, if you think 3 days is what you're going to give to fixed income, I think you should make sure that that's about it. Okay, so don't go overboard on any of the particular areas. Unless and until you seem to be lagging behind in some particular area, you might want to give a little more than proportionate time in that particular area. Okay, and just set number of hours for every day and try and meet that. The penultimate 48-hour strategy, what should it be? So just a sec. I think am I able to get your comments? Okay, yeah. So the last 24-hour strategy, what should last 48-hour strategy, what should it be like? I think that's the time when you should not panic. You should just set out concise notes or concise items which you think were problem areas for you and just go through it. One of the don'ts, or rather one thing which you should avoid doing in the last couple of days is testing yourself with questions. I'm not a big advocate of it. So I think last couple of days you might just do well enough to look at questions and answers rather than testing yourself or putting yourself through mock tests. So mock test, if at all, should be taken in the next few days rather than leaving it for the last 1 week. Don't assess yourself before the exam or just before the exam. Okay, I think just leave it open. A good way of doing a quick revision is to look at questions and to look at answers. I mean, that helps you have a very quick coverage over all the topics. All right, so what's the exam like? Most of you would already know. Well, there are two papers, the AM and the PM session. No issues, Kritika. I think that is something very, very normal. So Kritika is asking, she is done with the course, she is revising, and she feels that she doesn't remember some of the concepts, so that worries her. I mean, try and mark those, highlight those concepts, and make sure that as and when you do it again, those are the concepts where you spend a slightly longer time. But then feeling a little nervous about whether you really retain whatever that you've gone through, I think that's absolutely normal. The syllabus is quite humongous, and trust me, even when I go through it, or when I had gone through it, there was a similar feeling whether I have done enough or whether I really retain what I've gone through. So that's absolutely normal. It's just that once you are into the exam hall, just tell yourself you are the best. I think that's the way to go about. I mean, irrespective of how my preparation was for any exam, once I would step into the hall and once the paper is there before me, things become much easier. You have those 120 questions before you, they are there before you, so you don't really need to speculate what is going to come in the exam and what not, what to study and what not. There you have 120 questions, you have 360 options, and that's it. I mean, it makes it a lot easier, right? So stay focused in the exam and feel positive. I think the best way to go about is tell yourself that every question is doable, and whatever that you're thinking on, your line of thinking is correct. All right, now nearly 40% is the pass rate. That means out of every 100 candidates, nearly 40 would filter through level 1. There's no hurdle score. You should maximize your chances. There's no negative marking, so don't leave out any question. While you write your exam, if there is some question that you've got stuck into and now you want to move on to the next question, please mark one of the three options for the question where you've got stuck into. So because you've already invested some amount of thinking into it, so irrespective of whether you've been able to crystallize upon one of the three options, I think it makes sense just to intelligently guess, or if you have a choice between two options which you think one of them is going to be likely, just go ahead and mark it and move on. If you want to come back to the same question, I think at best what you should do is attempt the question, mark the question in the question paper or in the bubble sheet somewhere along. I would suggest in the question paper, mark that question, attempt it, and keep a marker on it so that in case if you have time left at the end, you could just go back and have a relook at those questions. But then having invested a minute into the question and then letting it go without marking it, just to think that you're going to come back to it, think correctly the next time, and you're going to do it, I think that's a little, that's being a little unreal. Okay, apply common sense in case you don't seem to be very clued about the question. Just apply your common sense, mark it, and move on. Okay, so I think it would be suicidal for you to be spending like 3 minutes, 4 minutes on any single question. Please don't do that. Am I not audible? Am I audible? I mean, others, can you guys hear me? I think Nitish is having a problem. Are others able to hear me? Okay. Nitin, I think there is some problem at your end. Others are able to. Okay, great. Fine. So let's move on. So what are we going to do today? We're going to look at some important topics. Now, think of it. I am going to look at quants, derivatives, fixed income, portfolio management, a bit about economics, and a bit about alt investments. Now, I realize that we have nearly 2.5 hours. We've already kind of passed 10 minutes. So the kind of time that we have, I'm sure not all the areas we would be able to cover, but I have put it into an order, and the last two areas, one is economics, alt investments. I shall just make it a point to highlight what are the important topics that you should be going through. So while I might not deliberate on those topics, I will definitely emphasize certain specific topics, subtopics that you should be going through in the economics and the alt investment areas. Okay, so if time permits, I might just want to spend a little more time on currency exchange because that's one topic in economics which is very, very important. But we'll see in case if we have time. Otherwise, I'll definitely highlight the important areas. They are enlisted in my presentation, so I think it would be made available to you. Okay, so the first area that I'm going to take up is quantitative methods. So let us see, and I'm going to go very quick on certain topics, and some of them would be ones which you are quite familiar with. So kindly take it as a refresher. So and I try to highlight some of the common mistakes that the students make and some of the areas which are going to be the likely tested areas in the exam. Okay, so be careful about the sign while plotting cash flows. Now, this is in the context of time value of money that I'm saying. Now, kindly listen to it very, very carefully because I might not be writing everything that I say. Now, we all come across questions in time value of money where you might have, let's say, let me just try and set a problem where you would have to invest. So let me just use a marker. So let's say where you would have to invest $100 in year zero. So I think there's some problem with the marker. So $100 is what you invest, and 200 or let's say $50 is what you will get in the final year. So this is what you will get in the final year, and this is what you invest in year zero. I think there is some problem with the marker. And in year 5, you get $50. Okay, now the implied interest rate has been given to you. So let's say 10% is the interest rate which you're going to get. And so the question could be, what is the extra amount, the annuity amount that you would be getting in year 1, year 2, year 3, and year 4 and year 5? Okay, up over and above this final payment of $50, what else would you be getting in these 5 years? All right, so this could be a question where you have to invest $100 and Y1, Y2, Y3, Y4, Y5. You get a certain amount, and in Y5 you also get $50. So what should this amount be? Now make sure that when you are investing, it's a cash outflow, you take it as minus 100. So when you plug it into the calculator, take it as minus 100, take this as 50. Okay, many times what people do is they take PV as 100, FV as 50, and then they just go about calculating what is the PMT amount. Well, you end up making an error because and the calculator definitely is going to throw up an error because you've taken both the cash flows equally, right? You've taken them to be positive. So the calculator would not really understand which one is outflow and which one is inflow. So this is a very, very common mistake which students make. Just make sure, set a standard within your working that outflows are going to be taken as negative, inflows are going to be taken as positive. Okay, the next important stuff that you should be very, very conversant, very, very confident about is calculating the effective annual return, and this can show up in various contexts in the question. It can show up in various contexts. Now, all of you should be aware of what is effective annual return, right? So if I have bond equivalent yield being given as 10%, now this is the bond equivalent yield, 10%. Let me see if I can. Doesn't seem like we can do much about this marker, so there seems to be a problem. So let's say 10% is the bond equivalent yield, and they happen to ask us what is the effective annual return. So what would it be? If 10% is the bond equivalent yield, what shall be the effective annual return? Any guess, guys? Can anyone tell me? Yes? Any suggestion? Let me see. I mean, you should be very quick at this. Yes, are you guys there? Your effective, your bond equivalent yield has been given as 10%. What shall be your effective annual return? Well, great, Karan, that's correct. It's 10.25%. Nitesh, how is it going to be? So it's going to be 10.25%. Right? Now, it's quite easy to calculate. Bond equivalent yield is 10%. I take half of it because 10% is the bond equivalent yield, and we all know in bonds, conventionally, cash flows are half yearly. So the 10% quoted rate is equivalent to an effective 5% rate for 6 months. Okay, so 10% is the quoted rate, 5% is the rate for 6 months. So the periodic rate is 5%. And that getting compounded twice would make it 10.25%. So basically what you do is 1.05% square of it minus, there's some problem with the marker. So 1.05% square minus 1 would give you 10.25%. All right. So now this is important because sometimes they might just give you two bonds, and they might ask you to make a choice based on the YTM, the effective yield. Okay, not based on YTM. The YTM would be quoted. They might just ask you which of the two bonds happen to be higher yielding bond. One might be a quarterly bond, the other might be a half yearly bond. So a quarterly cash flow bond or a quarterly coupon bond, let's say, is trading at a YTM of 10%. So the quarterly coupon bond is trading at a YTM of 10%, and the half yearly coupon bond is let's say trading at a YTM of 12%. Okay, now of course these are far apart numbers, but just as a matter of example. Karan, there is going to be, so Karan has a question. We have bond equivalent yield covered in 3 topics. Should we follow the formulas as given in the respective sections? Yes, you should, but I believe there should not be any disconnect between the 3 formulas. There should be fair amount of consistency between how bond equivalent yield has been described as, irrespective of the topic that you're talking about. Okay, now let's look at this. Let me come back to this example. So a quarterly coupon bond has been quoted at an yield of 10%. A half yearly coupon paying bond is quoted at an yield of 12%. How do we compare these two bonds? Now what we do is we calculate the effective annual return for this bond as well as for this bond. For this bond, the effective annual return is going to be 1.025. All right, so I'm going to take 1 plus 1/4 of 10%, and then I will raise it to the power 4 minus 1, okay? So minus 1, and that should give me the answer. So 1.025 to the power 4 minus 1, and that gives me the effective return. For the half yearly coupon bond, we shall take 1.06 square minus 1. So you need to make them comparable. So the best way to make them comparable is to calculate the EAR for both these bonds. All right, so your EAR becomes a very, very important concept, and you should be very, very conversant with it. So let me now move on to the next slide. Okay, very important topic, guys. Almost take it from me. This is a high probability question area, the comparison between time weighted return and money weighted return. TWR and MWR. So let me go through it. Now the money weighted return, find out by plotting the cash flows and finding the IRR. Okay, as simple as that. So moment you know that the question is on money weighted return, plot the cash flows of the related situation and find the IRR. If it's time weighted return, I'm sure you would have plotted the cash flows for every intermediate period, calculate the returns, which I call as periodic return. Then calculate the compounded return out of the periodic return, and then get the effective annual return out of it. Okay, so I'll just take an example to calculate money weighted return and time weighted return. A very simple example, so I think that will work as a quick reckoner for all of you. So there we have it. So At time 0, I purchase a stock for $200. At time 1, I purchase another stock for $240. At time 2, I sell both of them for $260 each. The stock annually pays a dividend of $4 per share for both the years. So this is how it goes about. Okay. Now I need to calculate the time-weighted return as well as the money-weighted return. So how would I go about? Let us see. So let's see this. So you would argue that for me to calculate the money-weighted return, I should be calculating the IRR. Now, for me to calculate the IRR, I shall plot the cash flow. So at time T0, you purchase stock worth $200. So $200. Okay, I think there's a major problem with the marker. Okay, and at time T1, you purchase another stock for $240. So there's another cash flow of $240 in year 1. Okay, and in year 2, you sell both for $260 each. So in year 2, you would get $520. Okay, so $520. Now, not to forget that you're getting a dividend of $4 every year. So for the first year, since you had been holding only one share, you're going to get +4 dividend. And for the second year, since you had been holding 2 shares, you would be getting a dividend of $8. All right. So there we have 200 outflow in year 1, 236 outflow in year 2, and 528 inflow in year 3. I can calculate the IRR of this. I can easily calculate the IRR of this. In case if you have the calculator, just try working it out. It should turn out to be 13.86%. So I calculate the IRR of the given cash flows. Okay, that will give me MWR. So MWR is nothing but the IRR. Okay, which will turn out to be 13.86%. Now, this is how we calculate money-weighted return. Now, for me to calculate the time-weighted return, let's see how we go about. So let me erase this. Now, for me to calculate the time-weighted return, please remember for time-weighted return, you should track the asset rather than the cash flows. You should track the asset rather than the cash flows. It's just that I will identify the points of time based on where the cash flows are happening. Now, I realize that the cash flows happened in T0, T1, and T2. So those are exactly the points of time when I'll try to plot the asset. Okay, now the asset was worth $200 in time 0. In year 1, this becomes worth $240, and not to forget that it is paying a dividend of 4 as well. So the asset from a wealth perspective is making you rich by 244. So an asset which was worth 200, net price plus dividend is worth 244 by the end of T1. So calculate the periodic return. What is this return? You would say, well, this is 22%. This is 22%. All right, so there you have calculated the periodic return between 2 points of time. How did we discover the points of time? Well, these were the points of time when cash flows happened. Now, let's come to the next period, this one. Now, forget about this. Forget about this. What was the stock worth at T1? You would say, well, the stock was worth 240 at T1. All right, and what was it worth at T2? Well, it was 260. That was the price, and it gave a dividend of $4, so that makes it 264. Okay, so from 240 to 264, think of it. I reiterate, when you calculate the time-weighted return, you track the asset. Okay, what is the kind of return that you're getting when your value moves from 240 to 264? What's the return? Yes, guys, quick. You should be very quick at this. 10%. Wonderful, wonderful. So this should be 10%. All right, so you would say over 2 periods, the total cumulative return that I get is 1.22 into 1.1. Okay, so that's 1 plus R1 into 1 plus R2. And then, of course, I'm going to take the square root of it and deduct 1 from it to get the time-weighted return. So the key word that you remember is time-weighted return. You track the asset return. And in case of money-weighted return, you track the IRR. You track the cash flows and you calculate the IRR. Sorry. Now, let me ask you, if you were to assess the performance of a portfolio manager, right? I repeat, if you need to assess the performance of a portfolio manager, which of the two measures would be a more appropriate measure? Time-weighted return or money-weighted return? Yes, quick answer. If you look to assess the performance of your portfolio manager who'd been doing the stock selection, well, which of the two are you going to look at? Time-weighted return or money-weighted return? So I'm getting all sorts of answers. Well, Tanay is saying money-weighted, Sunny is saying time-weighted. Well, it's going to be your time-weighted return. Always remember the cash pullout and the cash inflow, the cash infusion and the cash pullout. The decision to buy another stock at T1 was yours. Okay, was yours. So as long as the withdrawal or further investment decision is being made by the investor and is simply beyond the discretion of the portfolio manager, then I think the best way to judge the portfolio manager's performance would be to look at time-weighted return. Okay, unless and until the portfolio manager also has a discretion on when to invest, when to pull out, when to further invest, which is rarely so, well, in that case, you might just look at the IRR or the money-weighted return, but kindly keep it in mind, it's going to be the time-weighted return if the manager doesn't really have the discretion of putting in additional money or pulling out money and paying it back to the investors. All right, okay, so manager's performance would be measured based on asset performance, and in that case, we shall take the time-weighted return. This is important, okay? Many times they ask questions on this. So let me now move on. Okay, now this is another set of, I would say, terms which are basically different ways of measuring returns or yields, which you need to be very, very conversant with. The bank discount yield, the holding period yield, the effective annual yield, the money market yield. Now, clearly, no matter how much you learn them, we tend to end up getting messed up, right? So I think the best way to remember these four terms and then to figure out the relationship between the four is to simply keep this particular example in mind. A $100 treasury bill, which has 100 days left for maturity, is trading at $99. Now, this is one classic example that you would keep in mind, okay? And try to work this out 3-4 times. This particular example, trust me, you don't have to remember the formula, how to calculate BDY, HPY, and so on and so forth. So let's take it up. A $100 T-bill with 100 days left for maturity is trading at $99. How will we calculate the bank discount yield? Now, the bank discount yield will be calculated by looking at what is the discount. A $100 T-bill is trading at $99. Finally, it will mature and give me $100. Today, it is trading at $99. So it's going to give me another $1 over the next 100 days. So that $1, when compared to the final value, 1 by 100, okay, is 1%. So you would say, well, the discount at which this bond is, not this bond, but rather this T-bill is trading at is 1%. Now, the discount is being calculated with respect to the face value. That's what BDY is. But further, you're going to annualize that discount. So you're going to take it into 360 by 100 because 1% is a kind of discount that is earned over 100 days of holding. So over 360 days, what shall be the annualized discount? Now, please remember, we're taking it 360 by 100. We are not compounding it, okay? So it's based on simple interest concept that we are annualizing it. So 1 by 100 into 360 by 100. So $1 is what I get over an investment of $99, which finally give me $100. So $1 divided by 100, which is the final value, into 360 by 100. So we annualize it, and it gives me 3.6%. Let me just go back to the previous. Okay, so that's how we get BDY. What is HPY? HPY is simply your holding period return. You don't look at annualizing returns. You basically look at what is the return that you are earning over whatever is your period of investment. You invested 99, you got finally 100, so 100 minus 99 by 99, 1.01%. That's going to be your holding period yield. So holding period yield is something that you can remember in general. It's not going to be the periodic return. It's going to be the return over your entire period of holding. Your effective annual yield, now given that it's annual, I am going to take HPY and approximate it to 1 year. So if over a 100-day period, I end up earning 1.01%, so on a compounded basis, what is the kind of earning that I can have over 365 days? So we'll take 1 plus HPY raised to the power 365 by 100, right? Because you would almost have 3.5 cycles within a year of 100 days. So 1 plus HPY raised to the power 3.65 minus 1, that gives me 3.74%. So that's almost like annualizing HPY on a compound interest basis. Okay, so what you need to remember is effective annual yield is being calculated based on a 365-day convention. The BDY was calculated based on a 360-day convention. BDY was calculated assuming simple interest and annualizing, and EAY is being calculated based on compound interest, okay, compound interest concept. Now, what is the money market yield? The money market yield is simply taking the holding period yield, but instead of compounding it, I tend to take it, I tend to annualize it based on simple interest. So I simply take 1.01% into 360 by 100. That gives me 3.636%. Okay, so in the case of MMY and BDY, we always follow the 360-day convention. All right, now this is one example that you should keep in mind. Just have it there in your mind, imprinted, work it out for a few times, and then I think you just know what is the linkage. Then once you get a question, try and map that question with this particular example. I think life would be much easier rather than memorizing the formulas. Okay, right. Thanks. Okay, wonderful. Chalo. Let's move on. Okay, these three topics or other concepts or terms that I'm taking up because they get tested very often. Now, I recall when I wrote my level 1, that's quite some time back, almost like 10 years back when I wrote my level 1. Well, I had around 3 questions on Sharpe ratios, and they were simply giveaways. I mean, quite easy to calculate. Okay, so all of you should know what's Sharpe ratio. So in case if you don't, well, remember Sharpe ratio. I think there's some problem with the marker, so my apologies in case if you're not able to make it out. So Sharpe ratio for any portfolio is going to be the return of the portfolio minus the risk-free return divided by the standard deviation of the portfolio. Okay, so that's how you would calculate Sharpe ratio. All right, and how would Sharpe ratio help? Well, Sharpe ratio is used as one of the performance metrics. So if I need to assess the measure of a portfolio, I can do so by calculating its Sharpe ratio. It's almost like a risk-adjusted return, return to risk kind of a measure that I'm getting. Now, even if I need to compare two portfolios, sometimes we do it based on Sharpe ratio. Okay, now Chebyshev's inequality. Anyone who remembers Chebyshev's inequality? Yes. Oh, we're going to come to it, Nitish. Safety first ratio, I'm going to come to it very soon. Chebyshev's inequality. Yes. Anyone remembers what's Chebyshev's inequality? Again, very important, guys. Yes, that's what it is. Yes, great, Nitish, Karan, Benjamin. Yeah, you guys got it right. Now, Chebyshev's inequality basically tells you what is the percentage of data that lies within a given range. So let me just take an example. Let's say I have a data whose mean is given. The mean is being given as 10. Okay, and again the standard deviation is being given as 2. All right, so there is a data. And listen to this carefully. I have not been indicated the probability distribution of the data. All that I've been given is the mean and the standard deviation. So I don't know how is the data distributed, whether it's normal, binomial, uniform, or some other distribution, or not really following any parametric distribution. Now that's something that I'm unaware of. Now I know the mean, I know the standard deviation, and somebody asks me, hey, can you tell me what percentage of the data would lie between the range 6 to 14? All right, 6 to 14. So the mean is 10, the standard deviation is 2. What percentage of the data, how many data points would lie between 6 and 14 in percentage terms? Now, how do we get that? Now, realize 6 is 10 minus 2 times standard deviation. 14 is 10 plus 2 times standard deviation. So this 2 times, the number of times of standard deviation around which I'm setting up the range, the number of times standard deviation around mean within which I'm setting up the range. Now that's going to be taken as K. Excuse me. So one would suggest that K out here is 2 because 6 is 10 minus 2 times standard deviation, and 14 is 10 plus 2 times standard deviation. Okay, so this 2 becomes K. So the percentage of data that would lie between 6 and 14 will be given approximately by 1 minus 1 by K square. Okay, 1 minus 1 by K square. So that becomes 1 minus 1 by 2 square. So which is 3 by 4, which is 75%. So you would say at least 75% of the data should lie between 6 and 14. I hope everyone's got it. Okay, so 1 minus 1 by K square. So, well, that we can't. So Sunny is asking how to find data between 8 and 14. So the kind of range that we take is equidistant around the mean. All right, so that is something that you should be aware of, and that in a sense becomes a limitation of Chebyshev's inequality. But I think the beauty of Chebyshev's inequality lies in giving us an answer, telling us some percentage of data that lies within a range without knowing the distribution of the data. So it could be normally distributed, binomially. We don't know what the distribution is, but it's correct. It tells me that at least 75% of the data lies between 6 and 14. Okay. Oh yes, we can. So Tanay is asking, can we calculate the percentage of data that would lie between 8 and 14 if the mean is 11? Yes, we can, because 8 is 11 minus 3 and 14 is 11 plus 3. And if I take the mean as 8, as Tanay is suggesting, or rather the mean as 11, as Tanay is suggesting, and I need to find out the percentage of data that lies within the range 8 to 14, I would say, well, I can, because 14 is 11 plus 1.5 times standard deviation, and 8 is 11 minus 1.5 times standard deviation. So replace K with half, and there you have it. Okay. Well, standard deviation is being taken equal, and it need not be symmetric distribution, Karan, because you get one single standard deviation figure for a symmetrical or an asymmetrical distribution. All right, so it would apply. Okay, great. So let's now move on. I think we guys need to be a little quick. So, okay, skewness and its impact on mean median mode. Okay, again, very important. Quite simple concept, but sometimes gets tested in the exam. Now, I hope everyone understands what is skewness. Now, if I have a symmetric distribution, and a good example would be that of normal. Okay, now this is having a skewness of 0 because it is absolutely symmetric around the mean. Okay, the distribution is absolutely symmetric, so the skewness out here is 0. When you have a symmetric distribution, then the mean is equal to median is equal to mode. So all the three are equal. All right, so that's a symmetric distribution. What would be a skewed distribution? Let's say if I have some positive outliers. All right, so that is when you would term it as positively skewed. Now this is positively skewed. Okay, so this is positively skewed. Now, it being positively skewed, because there are some positive outliers, it pulls up the mean. So now, while your mode remains over here, please remember your mode is the highest frequency data point, and in case of a continuous distribution, mode will be that data point which would correspond to this highest point, right? I mean, where this length becomes the highest. All right, so that would become the mode. Now this is the mode. On account of there being some positive outliers, your mean will get pulled up. So your mean might lie somewhere over here. This is where your mean will lie. And your median is always going to be between mode and mean. Okay, so your median might be lying somewhere over here. So kindly remember how mode, median, and mean will stack up against each other when you have a positively skewed data or when you have a negatively skewed data. So in case if I have a negatively skewed data, things are going to be exactly the opposite. So this is where my mode is going to be, this is where my median is going to be, and this is where my mean is going to be. My mean is going to get pulled down because of there being some very low values, there being some negative outliers. Okay, so kindly remember skewness and how would it impact the relationship between mean, median, and mode. So let's move on. Okay, let's come to kurtosis. Let's understand what's kurtosis, and I think best explained through the diagram. Now, here I have a normal distribution. This is a normal. Okay, and if I were to talk about leptokurtosis, well, that will get captured by, let's say, a figure like this. If I can draw it, superimpose it over this, this is how your leptokurtic distribution is going to look like. Okay, so what are we talking about? In a leptokurtic distribution, you have some points which are very near the mean, and there are quite a few more points which are very far away from the mean. So the intermediate data points that you have vis-a-vis the mean, they are going to be fewer in the case of leptokurtic distribution. So this is leptokurtic. Okay, now this is normal, and a normal distribution would be said to be mesokurtic, right? And then of course you will have a platykurtic distribution, which would look like, if I were to just change the color, let's say, let me take up green, a platykurtic distribution will look something like this. Okay, that means there are fewer points which are very near the mean, there are very few points which are far away from the mean, but there are a whole lot of points which are at an intermediate distance from the mean. Now, the interesting part is that these three distributions are symmetric, so their skewness is 0. They might have the same standard deviation, but in terms of kurtosis, they seem to be different from each other. Now, why are we talking about this? I mean, one is, I think, what you should know is which one is lepto, which is meso, and which is platy. The way I remember it is these are absolutely in alphabetical order. L, M, N, O, P. So that's how you remember it. Leptokurtic, mesokurtic, platykurtic. All right. Now, why is it important for us to know the kurtosis? Now, this is important because, I mean, just look at what I've written down there. Positive kurtosis and negative skewness could enhance the risk of the portfolio. Because if I have a leptokurtic distribution, which means that the tails are thick, that means there are a whole lot of points which are very, very far away from the mean, which are negative outliers. And that is something which a risk-averse investor might be very, very wary of. So a positive kurtosis, that means a kurtosis which is in excess of the kurtosis of a normal distribution. The kurtosis of a normal distribution is 3, guys. So leptokurtic distribution has a kurtosis greater than 3. So what essentially I imply is a positive excess kurtosis. So that means greater than 3. And negative skewness, that means I have some negative outliers. So a negative skewness combined with positive kurtosis is a red flag, is something that is going to worry the risk-averse investors. Okay, so kindly remember, kurtosis and skewness are risk characteristics which normally gets ignored because we tend to confine our risk analysis by way of standard deviation. All right. Okay, so let's now move on. So probability in terms of odds for and odds against. Now that's again a low-hanging fruit. All of you should be aware of. Many times you get questions where okay, so many times you would get questions where they'll either quote probability and ask you to find out the odds for or odds against, or sometimes odds for, odds against will be quoted and you will be asked to find out probability. So let me very quickly take up a problem, something like this. So let's say the probability of default is 20%. So let me just write down these figures. The probability of default is 20%. All right. So let me ask you, what are the odds against default? Can you guys tell me what are the odds against default? The probability of default of, let's say, a bond is 20%. What are the odds against default? Yes. Okay. Okay. Sunny says 0.8. Is that how we describe odds? Well, not really sure. Karan says 1.25. The probability of default is 20%. What are the odds against the bond defaulting? Look at this, how we put it. Please pay attention, guys. The probability of default is 20%, which means 2 by 10. Okay? Now, look at this, what I say. Now, the probability of default is 2 by 10. Now, look at how I've rephrased this. And this is not being very, very purist in statistics, so but I think it works. Out of the 10 individuals, 2 individuals think that this is going to happen. That's how I would like to put it. So out of the 10 individuals, 2 think that there would be default. 8 individuals think that there isn't going to be a default. So 2 are for default, 8 are against default. So out of the 10 individuals, 2 seem to say that there's going to be default, and hence we say probability of default is 2 by 10. Okay, so if somebody asks me, hey, what are the odds against default? I would say 8 is to 2. 8 is to 2. The odds against default is 8 is to 2. So 8 individuals are against default, 2 individuals are for default, or we can simplify it and say 4 is to 1. Okay, I hope this is clear with everyone. 8 is to 2. So what are the odds in favor? 2 is to 8. The odds in favor, 2 is to 8. Okay, so that's how you're going to write it. All right, fine. So sometimes they would give you odds for or odds against, and they might ask you the probability. So guys, you should know it. So the odds against default is 8 is to 2. So I would say the probability of no default is 8 by 10. So 8 by 8 plus 2. The probability of default is 2 by 8 plus 2. Okay? Wonderful. Bayes theorem, again, very, very important. I'm just trying to touch upon the important aspects. Now, Bayes' theorem is something that we struggle learning it, and I prefer doing Bayes' theorem by way of a tree diagram. So I'll take a very quick example. I don't know, I'm going to struggle with this pen, so I don't know how effectively I would be able to plot this example. So let's say we we said, well, the economy can do well, the economy might not be able to do well. So let's say the economy does good, or let's say the economy doesn't do all that good. So we'll take binary situation, good and bad, as far as the economy is concerned. Now, in case if the economy does well, the stock might go up. But sometimes, in spite of the economy doing well, the stock might go down. Economy not doing well, doing badly, the stock might go up, and most likely it will go down. Okay. Now, the probability of economy doing well is 60%. The economy not doing well is 40%. Going up, in case if the economy does well, the chances of the stock going up is 70. And in case if the economy doesn't do well, then the chances of going up is 10. Okay, now I'm going to throw a flurry of questions and I'm going to expect prompt answers from you guys. Okay, now what is the probability of the economy doing good? Let me get the answers very quick. What is the probability of the economy doing good? Yes, can I have an answer? 60%. Well, that's there on the screen. Okay. What is the probability of the stock going down given that the economy is doing good? What is the probability of the stock going down given that the economy is doing good? I repeat, what is the probability of the stock going down given that the economy is doing good? Well, it's going to be 30%. It's conditional probability that I'm asking, guys. So you can't be giving me joint probability as the answer. You can't be telling me 30% into 60%, 18%. Well, that's going to be the answer to the question when I say, hey, what's the chance of economy doing good and the stock doing not so well, or the stock going down? Then you would say 60 into 30. Here my question was quite simple. What are the chances of the stock going down given that the economy is doing good? So it's conditional probability. It's going to be 30. Okay. Similarly, this conditional probability is going to be 90 because these two should add up to 100%. This two should add up to 100%. I hope I've made myself clear, right? Okay. Now, great. Now you can calculate the joint probability. 60 into 70, 42%, 60 into 30, 18, 40 into 10, 4%, 40 into 90, 36%. So you'll get all four combinations. All right. And that should not be difficult. So let me now toss around and ask you, what in case if the stock has done well, what are the chances that the economy had done well? So what are the chances that the economy was good given that the stock went up? This is what my question is. We can easily find out P U given G, that is 70%, all right? But what I'm asking is P of G given U. Now, given that you know that the stock has done well, so in the context of this new information, what is the probability that the economy might have done well? Yes, anyone who would like to take a shot at it? Yeah, can I have quick answers? I believe I'm audible. Okay. Okay, so Shibu thinks that he has an answer. Well, Shibu, in case if you have an answer, you can just go ahead and tell me. Okay, I shall just repeat the question for the benefit of all. You need to find out the probability that the economy has done well, given that you already know that the stock has gone up. Now, the stock could go up in the context of economy doing well. The stock could also go up in the context of economy doing badly, right? But given that the stock has gone up, what are the chances that the economy would have done good rather than bad? Okay, I'm already getting some answers. Okay, let us see how we go about. I think some of you are making sense. So let's see how we go about. Now we know that the stock has gone up. All right. If the stock has gone up, either this has happened or this has happened. Either this has happened or this has happened, right? Either the stock would have gone up in the context of economy doing well, or the stock would have gone up in the context of economy not doing so well. Okay. Now, the stock going up in the context of economy doing well, net has a probability of 42%. And so this joint probability is 42. And the stock going up, in case if the economy was doing badly, net the probability is 40 into 10, 4%. So out of this 56% possibility, which is now already confirmed that this has happened, out of not 56, it's 46. Out of this 46% event, which has already happened, 42% is on account of the economy doing good. So we would say it should be 42 by 46. All right, it's going to be 42 by 46. 60 into 70, 42, 40 into 10, 4. The stock can go up here or could have gone up here. So one of these two events would have happened. Now, out of this 46% event, 42% emanates on account of the economy doing good. So we would say, well, the probability that the economy has done well when the stock has gone up is 42 out of 42 plus 4, 46. All right. Makes sense? How much does it turn out to be? 91, 92%, around 91% approximately? Yeah. Great. Wonderful. I think some of you have got it right. Great. Okay. So shall we move on? I think this should be very clear. So in case if you get a question, I mean, forget about what Bayes' theorem is. Bayes' theorem essentially tries to recalibrate the probability by taking help of an information. So when a new information comes in, well, that's when you try to recalculate probability. So we are here trying to recalculate the probability of the economy doing good in the hindsight, well, in the context of getting this information that the stock has done well. All right. So not that you need to learn the Bayes' theorem by heart. I think you can very well do it logically. Okay. Now this again gets tested very often in the exam. I hope I'm audible and the slide is visible to all of you. Conditions for a probability distribution. Just a quick check. Everyone, all right? No problem? Okay, wonderful. Look at this. Conditions for a probability distribution. Now, normally you would get questions where they would give you a probability function and then they would ask you, or they might give you a few probability functions and they might ask you, hey, which one of it is valid or which one of it is not valid. Okay, now for a probability function to be valid, especially I think the kind of questions that you would get would be more to do with discrete rather than continuous, because there you will have to apply integration. So in case of a discrete probability distribution, how do we test whether it meets the condition of a valid probability distribution or not? Now, let me take an example. Let's say X can take the value 1, 2, 3, 4, and 5. All right. And I define the probability function as, which helps me get the probability of any of these outcomes as X by 15. Okay. Now, is it a valid function or not? That is what we need to answer. Now, if I look at what shall be the probability, so here I have X, here I have the probability of X. So X can take the value 1, 2, 3, 4, 5. and the probability of x could be, going by this function, it's x by 15, so it could be 1 by 15. Now, is 1 by 15 a valid number? You would say, well, of course it is, because the probability should always lie between 0 and 1. It could either be 0 at the lowest or 1 at the highest or somewhere in between. So 1 by 15 is absolutely fine. The probability of x being 2 is 2 by 15. This is going to be 3 by 15, absolutely acceptable. 4 by 15, 5 by 15. All right. So to that extent, the probability distribution function looks valid. Again, the summation of this should be 1. Is it so? Well, it looks like 1 plus 2 plus 3 plus 4 plus 5 divided by 15, it adds up to 1. So the summation of the individual probabilities should add up to 1. Okay? This should add up to 1. And the individual probabilities should lie between 0 and 1. These are the two conditions which should be met. This and this. Okay, individual probability should lie between 0 and 1, and the summation of the individual probabilities should add up to 1. All right, so the function could be a little more complicated, but then it still boils down to these two filters. So both the filters should be met. I hope this is clear to all of you. Roy's safety first criterion, again, important. So basically what we try to find out by way of Roy's safety first criterion is the kind of comfort that this portfolio might give me over and above my threshold return. So let's say I have an investor who says that, well, he is uncomfortable with anything which gives a negative return. So for him, the threshold return becomes 0. Okay, so here is an investor for whom the threshold level is 0%. So he is uncomfortable with any investment that gives a negative return. Now I have two portfolios available, So let's call them A and B. Okay, A has an expected return of 12%. And B has an expected return of 15%. Okay, the standard deviation, that means the standard deviation of returns of A, that is the risk metric, is 3%, and for B is 5%. Now, if I need to calculate the Roy's safety first criterion, the way I do it is that the chances of getting a 0% or lower in the case of A vis-a-vis in the case of B, where is it lower? I repeat, where is the shortfall risk lower? Is it in the case of A or is it in the case of B? Now, portfolio A might follow some kind of a distribution. All right, now it could be a normal distribution. So where the expected return is 12%. And of course, the possible return could be anywhere. So for this investor, the threshold return is 0%, guys. So he would want to get into a portfolio where this area is as low as possible, guys. He would like to get into a portfolio where this area is as low as possible. This area is a shortfall risk. Now, in the case of a normal distribution, I can easily calculate this area by converting 0 into Z and then trying to find out the area to the left of Z, isn't it? That should be easy, because if this is 0, 0 minus 12 divided by 3 makes it minus 4. So I will just look at the area to the left of minus 4, which is going to be hardly any, right? Now, if it's a Roy's safety first criterion, a better way, or rather a very quick way of figuring out between A and B which one is better, all that I do is, and carefully look at this, my Roy's safety first criterion, the safety first ratio, will get calculated as the return of the portfolio minus the threshold return. So let me call it the minimum return divided by the standard deviation of the portfolio return. So in the case of A, what shall be the Roy's safety first ratio? It will be 12% minus 0% divided by 3, 4. So in the case of A, it's going to be 4. In the case of B, how much is it going to be? Yes, 15% minus 0 divided by 5, it becomes 3. So we would go for A. The greater the ratio, the better it is. All right. So greater the ratio, the better it is, because this greater ratio will translate into smaller shortfall risk. Okay. Okay, great. So, well, I'm not going to discuss this, but just to flag this, guys, kindly be aware of the bias that creeps in while creating sample. I think you would have it within your material. Kindly make sure that you go through it, because this is again a very testable area. The kind of bias that sets in while creating sample could be the data mining bias, where essentially some patterns are taken to be rules. Okay, so there is some specific pattern that tends to get repeated in various samples, and so we set up a conclusion that that this pattern is almost like a rule, and well, there could be a pitfall out there. So data mining bias, it could be a survivorship bias where you tend to exclude certain data points because they are not available. And then you have, of course, look ahead bias. And a good example of a look ahead bias is when we tend to say that stocks which with low P to B ratios tend to outperform. I hope all of you are familiar with these biases. If you're not, just make sure to take out some time and read the biases while creating sample. Okay, that's an important part, quite testable. So I'm going to skip this discussion. Okay, type 1 and type 2 error, power of test, again very important, guys, gets very often tested in the exam. So let me just have a quick recall of this. We all have done hypothesis testing. All right, so let's just look at the power of test. Now we know that in hypothesis testing we are trying to test the null hypothesis. Now the null hypothesis, for all we know, might be true. Okay, it might be true. The null hypothesis, for all we know, might be false. Okay, might not be true. That's a better way to put it. Then again, I might not reject the HO, the null hypothesis, so not reject. Sometimes we simply say accept, but not reject is the better way of putting it. Or we reject the null hypothesis. Okay, so in case if the null hypothesis is true and we don't reject it, that's a correct decision made. In case if the null hypothesis is false and we end up rejecting it, that's again a correct decision made. So these two are the errors. This is known as the type 1 error. This is the type 1 error, guys. This is the type 2 error. Okay, so this one is the type 1 error, this is the type 2 error. Now the kind of questions that you would get in the exam is, they might simply give you a problem and they might ask you, hey, what's the probability of type 1 error? Please remember the type 1 error probability is the level of significance, alpha. So whatever level of significance that you set up for testing the hypothesis, that becomes the probability of type 1 error. All right. Type 2 error probability sometimes is given, sometimes not. Now, always remember this plus this is 100%, this plus this is 100%. Now, this will be 1 minus the probability of type 2 error. All right. It is also known as the power of test. So in case if you get a question in the exam, they might just ask you, the power of test is 80%. What is the probability of type 2 error? Now, once you know that the power of test is 80%, the probability of type 2 error becomes 20%. So one of these two would be given. Sometimes they will give you the type 2 error probability as 20%, and they might ask you, hey, what's the power of test? So you would say 1 minus 20%, which is 80%. All right. Now, is there a way of reducing error, diminishing error? In case if you look to suppress type 1 error by taking a lower level of significance, the chances of type 2 error would go up. So it's almost like a seesaw. You try to pull down type 1, type 2 would go up. You try to bring down type 2, type 1 will go up. The only way, and listen to this carefully, the only way to reduce diminish both type 1 and type 2 error would be to increase the sample size. Okay, so when I increase the sample size, that's when I reduce the probability of type 1 error as well as type 2 error. Okay, right, so let's just move on. I think we have had enough of quants, so I'll very quickly move on to derivatives. Okay. Very quick revisits of certain topics which I think might be asked or tested in the exam. One is the concept of the difference between the value of a derivative and the price of a derivative. More relevant in the context of forward contracts or forwards as we call it. Now there is a difference between the value of forward and the price of forward. Let me take an example. Let's say I buy a gold forward for $100 per unit. Okay, I'm just taking a random price. So $100 per unit, that's the price at which I buy the forward. Now $100 would become the price of the forward. So if I go long gold forward at $100, now that's the price of the forward. What is the value of the forward? Can anyone answer me? What is the value of the forward? Yes, I buy gold forward at $100. What is the value of the forward? The value of the forward is going to be 0, because always remember the value of forward is 0 at inception. So while the price is going to be $100, the value is going to be 0. Now, this is very, very different from the way we understand it for assets. The stock is priced at $100 and we would like to believe that the fair value of the stock is $100. So there is a lot of semblance between value and price in the case of conventional assets or in the case of assets. In the case of forward, especially in the case of forward, there is a discrepancy. You would understand value and price differently. Now, well, let's say a few days later, the forward price, the kind of agreement or the kind of forward contract that I had gone long is priced at $120. So what do you think should be the value of the forward at that point of time? The price is 120 for a comparable forward which I bought for $100. So you would say, well, sir, the value of your forward contract is nearly $20, or may I say the present value of it, whatever is the present value of it. So you're going to look at the value of your forward contract, but it would be in terms of the present value. So kindly be very, very clear that this $120 is what you're going to get at the time of settlement. So something that you are going to buy for 100, others are going to expectedly buy for 120. So you end up making a gain of $20 expectedly, and the value of the forward at this point of time is going to be the present value of $20. Okay, so the value of forward would become positive or negative once the contract set in, but the price would basically be this. That's the contract price. Okay, so kindly be aware of the difference between value and price, especially in the case of forward contracts. Moving on. FRA, synthetic FRA, again, very, very important, guys. So let me ask you very quickly, you guys going to answer this question. So one thing, long FRA means I am going to borrow on a forward basis. Short FRA means I'm going to lend on a forward basis. Okay, so this is something that should be very, very clear. When you are going to buy a FRA, forward rate agreement, that means you're going to borrow on a forward basis. When you sell a FRA, you're going to lend on a forward basis. Now, I'm going to take a 60-day. Now, you guys got to answer this. I'm going to take a 60-day FRA. I'm going to take a 60-day FRA on 90-day LIBOR. Okay, I'm going to take a 60-day FRA on a 90-day LIBOR. So what would this forward rate agreement look like? Now it's a 60-day FRA on a 90-day LIBOR. In simple English, it would mean that I've entered into a contract to borrow money 60 days from now for the next 90 days. So this is day 60, this is day 150, and this is day 0. So if today I buy a 60-day FRA on a 90-day LIBOR, it means on a forward basis, 60 days hence, I'm actually going to borrow the notional principal for the next 90 days. All right, this is what a 60-day FRA on a 90-day LIBOR would mean. Now let me ask you, so this is where you're going to borrow on a forward basis. How do you create a synthetic FRA? How would you create a synthetic FRA? So without taking a position, a long position in the FRA, how would you create a synthetic FRA? Yes, any suggestion? How would you create a synthetic FRA without really getting into a FRA, without really taking a position in FRA, but you recreate the same impact? How would you do that? Yes, any answer? Okay, can I have some quick suggestions on this? It's important, guys. So Sunny says, I'm going to lend for 2 months. Okay. Yes, but that's an incomplete answer. Okay. I would say for you to create a synthetic FRA, what you would do is, so let's say this is 150, this is 60, and this is 0. What you do is, you borrow for 150 days, and you lend for 60 days. So I'm going to lend for 60 days and I'm going to borrow for 150 days. That effectively will create the same impact as I would have it over here. All right. So I'm going to borrow for 150 days and I'm going to lend for 60 days. So this 60 days lending and this the first 60 days of borrowing kind of nullify each other. So effectively, I borrow for the next 90 days post 60 days. All right. So that's how you create a synthetic FRA. Okay. So this is important, guys. Well, Sunny, all that we are trying to do is, instead of getting into a derivative position, so instead of let's say having a FRA, what I do is I engage into borrowing and lending to recreate the same impact. Okay. Now, where else can it help you? Sometimes you would be able to detect the arbitrage opportunity between FRA and synthetic FRA. Okay. Not too sure whether this would be the right time for me to discuss this example, but let's put it this way. I might just want to take a simpler example to explain you where it might help. So let me erase this. So let's say I'll take a simpler example. So let's say you basically enter into, you have a FRA available to you which will help you borrow money 1 year down the line. So this is year 0, this is year 1, this is year 2. So here we are talking about a 1 year FRA based on a 1 year LIBOR. So basically I'm taking a 1 year loan. I'm going to take a 1 year loan 1 year from now, and the FRA rate that is available to me is, let's say, 12%. That means on a prospective basis I can borrow for 12% in the second year. Now, in case if I've been given the 1 year spot rate and the 2 year spot rate, you can calculate what is going to be the forward rate, isn't it? And this is important, guys, because many times in fixed income, they give you forward rates or they give you spot rates and they ask you the other. So let's say the 1 year spot rate is 11%, and the 2 year spot rate is 12%. Okay. So the 2 year spot rate is 12%. So guys, tell me, where does it make sense to borrow? Should I borrow by way of FRA or should I borrow by way of synthetic FRA? Yes, any suggestion? Or is there an arbitrage between the two? The 2 year spot rate is 12%, the 1 year spot rate is 11%, and I have a 1 year FRA 1 year from now available to me at 12%. Yes, any suggestion? Quick, guys. Do you spot an arbitrage over here? What is the implied forward rate that you get over here? What is the implied forward rate for this 1 year from now? Yes? Can I have an answer to this? What is the implied forward rate? This is something that you guys need to be very, very conversant with in fixed income. What is the implied forward rate for this if the 2-year spot rate is 12% and the 1-year spot rate is 11%? Well, approximately it's going to be 12 into 2 minus 11, isn't it? 12 into 2, 24, 24 minus 11, 13%. I'm just taking the arithmetic approximation. Nitish has given me a more exact answer, which is 13.01%. So you would say when I borrow for 2 years and lend for 1 year, effectively I'm borrowing at 13%. And out here on a forward basis, I can borrow at 12%. So what I do is I go long FRA and I go short the synthetic FRA. I hope everyone is able to get me. So I'm going to go long FRA and I'm going to go short synthetic FRA. So going long FRA means I'm going to buy this, and going short FRA would mean I'm going to do exactly the opposite what is being plotted over here. Here you borrow this and you lend this. Shorting this would mean you would lend for 2 years and you would borrow for 1 year. I hope I've made myself clear. Okay, well, if at all you get a question like this, that's going to be a little more tricky one. But yes, don't rule it out because synthetic FRA is something which is relatively a new addition to level 1 syllabus. Moving on. Okay, difference between forward and swap. Well, we all understand swap as a bundle of forwards, but guys, remember forward at inception is 0. Swap, when you will take it as a bundle of forwards, all those forwards might have some value to begin with, negative or positive values. All right, so this is a distinction that you ought to remember. So while forward could be considered as a bundle, while swap could be considered as a bundle of forwards, some of these forwards are going to have positive value, some of these forwards are going to have negative value. Net, the value of swap at inception is going to 0, but individual forwards which constitute the so-called swap will have some positive values or negative values, unlike a single forward which at inception has a 0 value. Put call parity. Well, you can't really get a more important topic than this within derivatives. Now, I'll very quickly outline the kind of questions that you might get in put call parity. So, do you guys remember what's put call parity? Yes. Do you all remember what's put call parity? Put plus the stock is equal to call plus the bond. Isn't it? The present value of face value of the present value of the strike price. So put plus the stock is equal to call plus the bond. So how do you remember? Just plot them in alphabetical order. B and C are closer to each other. P and S are closer to each other. So they stay together. This is how you're going to put it. So this is how we would define the put call parity. How does a put call parity help? Okay. In the context of exam, how would you apply the put call parity? Okay. One variety of question that you might get is where they will give you the value of put, they might give you the value of the stock, they might give you the value of the call, and they might ask you, hey, what's the risk-free rate which is prevailing in the market? They might give you the value of the bond, stock, and put. They might ask you the value of the call. So all that you need to do is just set up the put call parity and find the value of the missing variable, right? It could be call, it could be put, or one of these. That's one kind of question. The other kind of question that you would get is, and let me just take an instance. Let's say there is a stock whose 100 rupees, well, the stock is currently priced at 100 rupees. Okay. The put of that stock with the strike price 100 is trading for 5. The call of that stock with the strike price 100 is, let's say, trading for 7. And these are 1 year call and 1 year put, and the risk-free rate is, let's say, 10%. Okay, so this has been given to you. Now the question could be, how will you create an arbitrage? So if this is what has been given to you, The question is, how would you create an arbitrage strategy or suggest an arbitrage strategy if this information has been given to you? It's a 1 year call, 1 year put, the stock is trading at 100, the put and the call with strike price is 100 are being placed at a premium of 5 and 7. And what is being asked is there an arbitrage? And if at all there is, how would you create this strategy to make money out of this arbitrage? Yes, any suggestion? Very quick. The risk-free rate, the 1 year risk-free rate has been given as 10%. Yes, can I have a quick suggestion? How would I create an arbitrage strategy with the help of this put call parity? Yes. Now, how would I create an arbitrage strategy? I'm yet to get the answer. What would your arbitrage strategy consist of in terms of taking positions? Okay, let us see. What is this side equal to? You would say 105, right? 105. And what is this side equal to? The call value is 7. What is the bond value? Bond is taken as the present value of the strike price. So 100 divided by 1 plus R, which is 10%. So nearly $90, $91, nearly 91, I would say. So this adds up to 98, and this adds up to 105. Okay? So buy the lower side. So you would say my arbitrage would consist of buying the call. So I'm going to buy the call. I'm going to buy the bond. I'm going to sell the put, and you will always sell the higher side. You will buy the lower side. So I'm going to buy the call. I'm going to buy the bond. I'm going to sell the put. I'm going to sell the stock. So try and look within the options. Well, these kind of positions. I'm going to buy the call. I'm going to sell the put. I'm going to sell the stock. What would you mean when I say I'm buying the bond? Buying the bond would mean lending money. So I'm going to buy the call. I'm going to lend the money. I'm going to sell the put. I'm going to sell the stock. Is it clear? So put call parity will also help you in figuring out what should be the arbitrage strategy. You buy the lower side, you sell the higher side. Buying the bond would mean lending money. Selling the bond would mean borrowing money. All right. Okay, valuation of option binomial approach. All of you are comfortable with it? I just wanted to highlight that this is important. It's a recent inclusion. Earlier, valuation of option binomial approach would be part of level 2 syllabus, but I think the one period, one step binomial approach has now been included in your syllabus. So all of you need to be very, very conversant with this. I hope you guys are. In case you all are, I might just want to skip this. Yes, it's your call. So you can I just have a quick sense on this? Would you guys want to discuss valuation of option binomial approach? Let me tell you, this is important, okay? And in case if you know it, great. But I just wanted to mention that this is important. Yes. Okay. Okay. So Ashish, in that case, I shall skip this. I would assume others feel the same. In that case, I might just skip. Okay, Tanya wants to discuss the binomial approach. So Ashish, if you can just bear for a few minutes, we can just go ahead and discuss a simple example of binomial approach. Okay, let's take this. Now, a binomial approach would be one way of valuing options. So let's say there is a stock which is currently priced at 100. It can go up to 125 over 1 year, and let's say it can come down to 80. Okay, and somebody asks you to value a 1 year call with the strike price 100. So you have a call with the strike price 100, okay, and you need to find out the value of this call. So I don't know the value of this call, okay, and this is a 1 year call. All right, I need to value this call. So how do I value this call? Mind it, it's a one-step binomial approach. So I would say, well, this is a call which has a strike price of $100. In case if 1 year down the line the stock is 125, what shall be the value of the call? Yes, can I have quick answers? If the stock price is 125, what shall be the value of the call? Yes. In case if the stock price is 125, what shall be the value of the call? Wonderful. It shall be 25. Okay, in case if the stock is 80 1 year down the line, what shall be the value of the call? Yes, can I have quick answer on this? Well, it's going to go worthless, so it's going to be 0. Now, I need to find out the value of the call today based on the outcomes 1 year down the line. So I already know the kind of outcomes that I might have 1 year down the line. Now look at this, how we do it. We take up the risk neutral approach. Now the risk-free rate has been given as 10%. So kindly pay attention. First, I shall try to find out the probability of upside and the probability of downside being indicated as P and 1 minus P. These are known as risk neutral probabilities. So I would say 125P plus 80 into 1 minus P divided by 1 plus the risk-free rate. Let's say the risk-free rate is being given as 10%. So I shall take 1 plus the risk-free rate as 1.10. So this is the expected value of the stock 1 year down the line, discounted with the risk-free rate, equated to the current stock price. Now you would say, well, we don't discount the stock with the risk-free rate, we discount it with the risk-adjusted rate. That's precisely the point. We are taking a risk-neutral approach. That means we will discount it with the risk-free rate to get the value of probabilities. These are not natural probabilities, these are risk-neutral probabilities. So very quick, can you guys tell me what is the value of P and 1 minus P that you get? Can I just have quick answers on this? Somebody who could solve it out and give me the answer? P and 1 minus P. What's the value? Yes. Yes, any of you? Aditya, Kapil, I think you guys have been there idle for a while. Can you guys give me the probability value? Yes. So 66%. Okay, wonderful. So what I'm getting is P is 2 by 3, if I got it right from you guys, and 1 minus P is 1 by 3. Okay, so this is 2 by 3, this is 1 by 3. The same probabilities are being extended over here. All right, 2 by 3, 1 by 3. So what shall be the value of call? You will take it as 2 by 3 into 25 plus 0 into 1 by 3, which is 0. So I might as well leave it out. So just for the sake of general expression, let me write this, divided by 1.10. All right, this gives me the value of the call today. That's what binomial approach is all about. Now in the book you would see that they have given you a certain description of P and 1 minus P, how to go about calculating it. You might very well calculate it logically by way of this. All right, so as long as you know the up factor, 100 into 1.25 gives me 125. Okay, Tanay is asking how did we get 1.1? Well, Tanay, we did take the risk-free rate as 10%. So I've taken 1 plus RF, which is 1 plus 10%. In certain cases, we take the continuous return. So in that case, I would have taken e raised to the power 0.1. Okay, so risk-free rate as 10% has been given in the problem. All right, so I hope all of you are now comfortable figuring out what shall be the value of the call, how to get the value of the option. So how would we get the value of the put with the strike price 100? Can anyone give me a quick answer how we get it? Can anyone tell me what should the approach be if I need to get the value of a put with the strike price $100? Now if the put has a strike price of $100, on the upside it will have a value of 0. On the downside, it will have a value of 20, isn't it? Because here the stock is 80. All right, so the value of the put is going to be 2 by 3 into 0 plus 1 by 3 into 20 divided by 1.1. There we have it. Okay. Okay, I don't know, Benjamin, I'm not calculated, but I believe you might be right. So 2 by 3 into 0, 1 by 3 into 20 divided by 1.1. Okay, okay. Now it might just make sense to try and place the value of call and put in the put call parity. You have the stock price, you have the risk-free rate, and you'll see everything falling in place. Okay, fine. So let me now move on. I hope everyone's comfortable with this. Binomial approach, one step. Well, this is all that you need to know. Okay, this again is very, very important, guys. American versus European option. Now, we all understand that American options can be exercised any day uh, till the day of settlement, while European option per force can be exercised only on the day of settlement. Now, what am I alluding at? The question that you would get in the exam more likely is going to be on lines where they might ask you situation where the value of American call is going to be greater than the value of European call, or let's say the value of American put is going to be greater than the value of European put. Normally, American options tend to be more or less the same value as European option. If at all, the American options will have a value greater than European. So if I may write, so listen to this, American options will have a value equal to European or greater than this. More often, the two values are very, very near to each other. Under what circumstances will the call value, American call greater than European call, American put greater than European put? Those are the instances that you need to know. Now, American call is going to be greater than the value of European call in case, and let's say if I take the example of a stock option, in case if some dividend payout is going to happen during the period of expiry. Okay, so let's say it's a 1 month option. The stock is currently trading at 100. The strike price of these calls happen to be, let's say, 95. Okay, so the strike price of American call or European call is 95. And the stock currently is trading at 100. 5 days down the line, it's going to pay a dividend of $15. Okay, $15 dividend it is going to pay. So can you guys tell me, if 5 days down the line, what is going to be the more likely price? If $15 is going to get paid as dividends and the stock is going to go X dividend 5 days down the line, what is going to be the more likely price of the stock? Yes? Any suggestion? You guys have done equity, you should be knowing it. It should go down, and theoretically I might believe that it should be somewhere around $85, right? So if the base price doesn't change much, if it goes down and becomes X dividend, it should be somewhere around 85. Now wonder, if I have a call with the strike price 95, things look good as long as the stock price is 100 because my call is in the money. When it goes to 85, my call is almost out of money, there being a great risk of it going worthless finally on the day of expiry. So in case if I happen to hold an American call, I do have the right to exercise it right away when the stock is trading at 100. When I know very well that 5 days down the line, a $15 dividend will be paid out or the stock is going to go X dividend. So I will exercise the call. In the case of European call, you can't do much, but you might hold on to the option or you might want to sell it to somebody else. But somebody else as well will give you a very low premium knowing well that this call is effectively out of the money call. So this is exactly the situation where American call would be perceived as more valuable than if European call, because of the flexibility of exercising it early, well before the stock going X dividend. All right, so this is the situation where American calls would tend to be more valuable than European call. The next situation where American put is going to be more valuable than European put. Well, this will happen when the stock price goes down. So let's say I have a put with the strike price $100, and let's say theoretically the stock has gone down to, let's say, anything like $10 or $0 or nearly $1. Now that's when the put is almost getting valued at $99, isn't it? The strike price is, let's say, okay, let me take a more real number. The strike price is $10 while the stock price has come down to, let's say, $1. Now the put will get valued almost at $9. Now, somebody might think, somebody who's holding the put might think that it's better to exercise the put because I'll immediately get $9 and I can invest this $9 for some period and get a far higher payout at the expiry date instead of holding on to the option, which currently is very valuable. But then what if the stock price goes up? Then the value of the put might go down. All right, because as it is, the stock has come down from, let's say, 12, 10 to 1. So there is chance of it going down, but there is as much chance of it going up. which can spoil the party. So somebody who happens to hold an American put, which is deep in the money and where the interest rates are very high, might want to exercise the put early on and invest the money. All right. So that's when an American put would be taken as more valuable than European put. When the put is deep in the money, coupled with high interest rate, making an early exercise an attractive proposition, and hence rendering an American put to be more valuable than a European put. So guys, kindly remember circumstances when American call is more valuable than European call, American put is more valuable than European put. All right, this is quite important. Okay, let me now move on. Protective put covered call. I'll skip this. All that I wanted to, while I wanted to discuss this, I think we are just running against time. So I might just want to highlight that these two are important strategies, might get tested. Protective put is when you buy the stock as well as you buy the put, while a covered call is when you buy the stock and you sell the call. In both the situations, you might get questions where they might ask you break-even price, they might ask you the maximum profit or the maximum losses, and so on and so forth. So let me just take a quick sense of the attendees. So, do you think you are well comfortable answering those kind of questions? If yes, I might just want to skip this. Yes, a quick response on this. Yes. So I mean, yes would mean that should I skip this? Okay, a quick example would help. Okay. Well, Benjamin saying yes, you can. So just one example. Okay, I'll just give I'll give one quick example and then maybe move on. Well, we always have this tendency to. Okay, great. Okay, let me take an example, a very quick one. Let's say I buy the stock for $100. So there I have the stock which I have bought for $100. Okay. And at the same time, I buy a put with the strike price $100. Okay, so the strike price is $100, and I buy this put for, let's say, $5. Okay, now this is what would be known as a protective put when I buy the stock as well as the put. Now, what is the maximum money that I can make on this strategy? Well, you would say, well, sir, you can make a lot. If the stock goes to $120, what is the kind of money that you make on by the settlement date if the stock goes to $120? So you would say, well, my stock will get valued at $120. My put will become worthless. So net, I will have 120, and hence the money that I make is $15, isn't it? Because you invested 105 and you end up having 120. So $15 is what you make. Okay? Yes. Now, in case if the stock goes down, what's the maximum loss that you can make? Please keep it in mind. When you buy the put with the strike price $100, you have protected yourself till $100. Okay? So may I rephrase myself? You have protected yourself for any price decline below $100. So your purchase price was 100. Buying the put with the strike price 100 would mean that even if the stock were to go to 90, you are protected from the downside. Why? Because when the stock goes to 90, your $100 investment becomes $90. Your $5 purchase of put, this same put will be worth how much? Yes, can I have a quick answer? So in case if the stock goes down to 90, this put would be worth $10, guys. Okay, this put would be worth $10 because the put strike price is 100. The stock is now worth $90, so the put value will be 10. So you would say, well, I have invested 105. I end up having 100. So given your combination, your total portfolio value will never go below 100. Kindly keep it in mind. So the maximum loss that you would make can only be $5. So that's the maximum loss that you can make. So I think the best way to figure out the maximum loss is to look at a very bad situation and see what your total portfolio value will look like under those circumstances. That might just give you a sense of what your maximum loss is going to be. Now, can I ask you, what shall be the break-even point? Can I have a quick answer on this? What shall be the break-even point? The maximum loss is going to be $5, and this should be ample clear to all of you. What can be the break-even point? At what price point of the stock do you end up making no profit, no loss? Absolutely correct, $105. Because at $105, your total portfolio value will be 105, because the stock value will be 105, the put value will be 0, and that ends up giving you 105. All right? Absolutely. So that's how you would do it for protective put. Let me just have a quick example on the covered call, which I think comes more often than protective put. I have the stock at $100. So this is the stock. I buy the stock. I sell the call with the strike price $110. I sell the call with the strike price $110 for a premium of $5. Okay, now let me ask you, what is the maximum money that you can make? I bought the stock for $100. I sold the call with the strike price $110 for a premium of $5. What is the maximum money that you can make on this strategy? Well, it's going to be $15. It's going to be $15. How do you get it? Now, the maximum money that you make is when the stock price really goes up, okay, because you own the stock. So you would say, well, let's say if the stock goes up to 150, I'm just taking one random number. If the stock goes to 150, your stock will be valued at 150. The call that you had sold for $5, okay, now that will be worth $40 because the strike price was $10, and that acts against you because you had sold the call. All right, okay, so the stock has gone up to 150. The call had would now be worth $40, and that goes against you. So your net portfolio value is 110. And what did you invest early on? You bought the stock for 100. You sold the call for 5. So this 5 is an inflow. So net you had invested 95, and finally it is valued at 110, thereby giving you a profit of $15. So that's one way of looking at it. The other way of looking at it is when I buy the stock at 100 and I sell a call with the strike price 110, I give myself a chance to make money to the extent of $10. But stock going beyond $110, I'll have to pass on the gains to the call buyer. But then I have premium to fall back upon. So 100 to 110, that's the journey that I enjoy. $10 plus $5 the premium. So the maximum money that I make is $15. Can I just have a quick answer on this? What's the break-even point in this strategy? Yes, quick answer. What's the break-even point on this strategy? Come on, guys. Come on. This is not correct. Benjamin, Tanya, this is not correct. Yes, it's going to be 105. It's going to be 105. Isn't it? At 105, would it be 105 or is it okay? 95. Okay, I think I stand corrected. Oh, absolutely. I think you guys scored on me over this. $95, because that's when you end up making a loss of $5 on the stock, and that is something that you recover by way of the premium inflow. Absolutely correct. So $95, absolutely correct. I stand corrected on this. So $95 is going to be the break-even point. Okay, right. I hope this is clear with all of you. Okay, so shall we move on? Okay, now the next part, fixed income. A very quick look at this. I think we just have little time, so I might just want to highlight the important topics. So apologies if I tend to skip more often than not. So I think these are certain varieties that you guys need to get it right. Floater, inverse floater, convertible, callable, puttable. Okay, now the kind of questions that you might get with respect to floater would be, listen to this carefully, guys. Pricing a floater. How do you arrive at the price of a floater? Okay. In terms of inverse floater, they might ask you, what is the structure? So have a good sense of what the structure of an inverse floater is. Please remember. So I might just want to give you some quick recall. A floater is one where you don't have a fixed coupon. The coupon is made equal to, let's say, some benchmark. Let's say it could be some LIBOR rate. plus a margin. So let's say LIBOR plus 2%. So that's how a floater will get designed as. Okay, so the coupon varies with interest rate, rendering the duration of a floater to be very low. So the interest rate risk in floater is going to be very, very low. Okay, now in case of an inverse floater, your coupon will get designed as a fixed rate. So they might just say 15%. So 15% minus the LIBOR. That's how, okay, I think okay. Okay, so kindly remember the basic structure of a floater and inverse floater. The duration of a floater is very low, so the interest rate risk is very low. In case of an inverse floater, the interest rate risk is very, very high. The duration is going to be very, very high for an inverse floater. A fixed coupon bond is, in a way, a combination of a floater and an inverse floater. So in terms of interest rate risk, floater has the lowest, fixed coupon bond somewhere in between, inverse floater has the highest interest rate risk. Okay, and kindly make sure that you work upon how to go about pricing a floater. There are a couple of examples in your material which indicates how to price a floater. Okay, so I'm not discussing it over here, but kindly take it, note it, get it registered with you that pricing a floater, how to value a floater is something which I perceive as important from an exams standpoint. And also I think a new entry in your syllabus is that in case if the credit quality of a floater changes, okay, the credit quality of the issuer changes and the kind of spread that the floater should command, let's say should not be 2%, but let's say 3%, then how would the price of a floater behave? The price of the floater will expectedly go down if the required margin goes up to 3%, because as it is, the floater is giving an extra spread of 2% and which is fixed. But then if the credit quality warrants 3%, then the investors suffer, and that's when the price of the floater would go down. So you might get a number problem where you would have to calculate or reprice the floater under these new circumstances. Okay, so I'm skipping those examples, but kindly get it registered with you. Make sure you work it out. Because this is important for your exam. Let me now move on. Okay, full price, flat price, matrix pricing. I think these are terms that you should be aware of. Full price is the fair value of the stock, fair value of the bond. Flat price is when you take the full price and you deduct the accrued interest, okay? Because there are times when the transaction of the bond happens somewhere between the two coupon dates. All right, so you would take half the coupon amount and deduct it from the full price to get the flat price. Full price is also known as the dirty price. Flat price is the clean price. There is a new entry into your syllabus, a relatively new addition, and hence I see the possibility of this being tested in the exam, matrix pricing. So I hope you guys are familiar with this concept of matrix pricing, where we try to approximate the YTM of, let's say, a hardly traded bond or an infrequently traded bond, right, by way of interpolation between two bonds. I hope this is something that you guys are familiar with, matrix pricing, where you try to interpolate the YTM of a bond based on the YTM of two other bonds being given to you. Is it? In case if it is, then I might just want to skip it. Or else kindly note it with you that this is something that you guys would want to go to. Okay? Okay, great, thanks. So kindly register it with you all that matrix pricing is something that you might want to go through. Pricing a floater, I've discussed that. Spot rates and forward rates, very, very important, guys. It's a simple topic, and this is something that you should become very good at, because, well, rarely comes a term where the institute would skip this topic, spot rates and forward rates. Let me just take a very quick example of this. So let's say we have the 1 year, 2 year, 3 year spot rates being given to us. Okay, so this is year 1, year 2, year 3, and I've been given the 1 year, 2 year, 3 year spot rate. So S1, S2, and S3 are being given to me. This is 10%, this is 11%, and this is 12%. Okay, so they might ask you all sorts of forward rates. So this is 10%, the 1-year spot rate. The 2-year spot rate is 11%, and the 3-year spot rate is 12%. So let me ask you, what shall be the 1-year forward rate 1 year from now? So I need to get this. What is the 1-year forward rate 1 year from now? Yes, can I have a quick answer on this? Just a quick, the 1-year forward rate 1 year from now. So sometimes we also call it F12. So this period 1, period 2, so the forward rate lying in between. Okay, what will this forward rate is going to be? What is this going to be? Yes, can I have quick answer on this? The 1-year forward rate 1 year from now. The 2-year spot rate is 11%, 10%. Yes. So 12.01. Okay, let me just give you a quick arithmetic approximation. It's going to be 2 into 11 minus 10. This is going to be 2 into 11 minus 10. So nearly 12%. All right. Okay. Let me ask you guys, what shall be the 1-year forward rate 2 years from now? What shall be the 1-year forward rate, this forward rate, 1-year forward rate 2 years from now? Yes, what shall that be? 1-year forward rate 2 years from now. It's going to be 3 into 12 minus 2 into 11. This forward rate is going to be 3 into 12 minus 2 into 11. Arithmetic approximation. So that gives me 36 minus 22, which is nearly 14%. So this is going to be 14%. All right. Okay, great. Wonderful, wonderful. Okay, last question. The 2-year forward rate 1 year from now. Quick, guys. 2-year forward rate 1 year from now. So if I would want to get this, the 2-year forward rate 1 year from now. Yes. So it should be 12 into 3, 36 minus 10, which is 16. So 16 is the overall, have I made a mistake? 12 into 3, 36 minus 10 makes it 26. 26 divided by 2, 13%. 13%, guys. It's going to be 13%. The 2-year forward rate 1 year from now. 12 into 3, 36 minus 10, 26. So 26 is the overall interest that would be captured over these 2 periods. So I annualize it. 26 by 2 makes it 13. It should be 13. All right. So the 2-year forward rate 1 year from now is going to be 13. Clear? Or you can also get it by taking 14 plus 12 divided by 2. So there are a number of ways of getting it. Okay, so guys, get very smart at finding out forward rates from spot rates and spot rates from forward rates. So because you might get questions of all types of combination from this. Well, you guys can take it from me. This is something that's a sure shot. It's going to come in the exam. Zero volatility spread, option adjusted spread, again, quite important. They might give you zero volatility spread and they might ask you to compute option adjusted spread. All right, so let me take a quick quiz on this. You guys need to answer that. Now, for a callable bond, okay, what is the relationship between option adjusted spread and zero volatility spread? Yes, guys, can you tell me? What is the relationship between option adjusted spread and zero volatility spread for a callable bond? Can I have a quick answer on this? Yes. Aditya, Rishikesh, I think you guys are sitting idle. Kapil. Yes, Tanya, go ahead. Okay, zero volatility minus call is equal to OAS. OAS is equal to, okay, so I think you guys are right. So my zero volatility spread is going to be greater than my option adjusted spread. So option adjusted spread plus the cost of the call becomes equal to zero volatility spread. Always remember, if I need to decide on buying or selling a callable bond, if I need to decide on my investment decision in a callable bond, it should always be based on option adjusted spread. So what is visible to me is zero volatility spread, which might be very high. The YTM of the callable bond might look very high, but you need to adjust for the cost of the call. So once you deduct this, you get the reduced YTM, which is the effective YTM, which is the option adjusted spread. All right. So in the case of a puttable bond, it's going to be exactly the opposite. Your option adjusted spread is going to be the zero volatility spread plus the put. Okay. So your option adjusted spread is going to be greater than the zero volatility spread in the case of a puttable bond. All right. So be very, very clear with this. Moving on. Portfolio duration, key rate durations. Guys, in case if you haven't, make sure that you just go through these. Do remember, guys, that portfolio duration will help you get the percentage change in portfolio value for parallel shift in yield curves. In case if you have non-parallel shift in yield curves, then it's the key rate duration that will help you calculate the change in the portfolio value. Okay. Price effect is equal to duration effect plus convexity effect. Well, do work out a few problems on this. Okay. Credit analysis is relatively a new addition to the syllabus, and I think one part which I personally think is quite important for the exam is the issue rating and issuer rating. What is the relationship between the two? Now, guys, do you think that if let's say a company like Reliance Industries, let's say which gets rated in a certain way, do you think all the bonds which are issued by Reliance over years, different series of bonds, do you think they all get rated at the same rating as the company itself? Okay, Tanya says no. So the rating of Reliance Industries as a company is known as the issuer rating. If a Reliance comes up with a certain bond issuance, the kind of rating that that issuance gets is known as the issue rating. Okay, so chances are that issue rating could be different from the issuer rating. All right, because the company might have had or might have various kinds of bonds ranging from the senior secured bonds to junior bonds which are unsecured. Okay, so you have bonds which will get ordered in terms of security as well as in terms of seniority. Generally, the thumb rule is that the senior unsecured debt, I repeat, the senior unsecured debt, okay, this rating tends to be in line with the issuer rating because this lies almost in median across the different series of bonds that or the different series of debts that the company would have there in its balance sheet. So the company's rating is going to be somewhere in line with the senior unsecured debt. So clearly the senior secured debt or debts which are further up will tend to have a rating better than the issuer rating, and the rating of junior bonds or junior unsecured bonds are going to have a rating poorer than the issuer rating. All right. Now, generally we start off with the issuer rating and then we either improve the rating depending upon what is it that I'm looking to rate. So if I'm looking to rate a senior secured debt, then I shall start off with the issuer rating and then take a couple of notches up. In case if I take a junior unsecured bond, I'll start off with the issuer rating and then I take a couple of notches down. Now that rating being taken side or no lower side is known as notching. Okay, so you start off with the issuer rating and then you take either couple of notches up or couple of notches down, and that's known as notching. Always remember, for a company which tends to have a weak financial health will see more impact of notching. A company which has a very sound balance sheet, there might not be too much of a gap between the rating of a senior secured debt and a junior unsecured debt. and hence notching might not be very, very visible or might not be very, very significant for a company which has a very, very strong balance sheet. All right, so keep that in mind. This concept is important. You might get an easy question as long as you are able to figure it out, as long as you are able to comprehend this concept well. Let me now move on. Okay, portfolio management. Computing portfolio return and risks, that's something that you should know. Correlation and risk. Higher the correlation between assets, lower the scope of diversification risk, and lower the correlation between assets which constitute your portfolio, greater shall be the scope of diversification of risk. So lower the correlation, the better it is. So when I get into portfolio management, I would always be looking out for assets which have good expected returns and which tends to have low correlation with my existing portfolio. So that can serve as a good addition to my existing portfolio. Guys, you should know capital allocation lines, CML, SML. Very often they ask you the difference between CML and SML. Okay, CML is capital market line. So that is something that you draw when you will have standard deviation as the risk metric and return as and R as the return metric, of course, as it is. So your capital market line is nothing but some kind of a tangent to your efficient portfolio curve, which is your Markowitz frontier. So if this is your Markowitz frontier, the tangent to this emanating from RF is known as the CML. So for a CML, the risk metric on the x-axis is standard deviation. Unlike a CML, in SML, you have beta along the risk axis, and of course you have return. Now, by virtue of having beta on the x-axis, all the stocks, if the market is efficient, all the stock would lie along the SML. So the stock might lie over here because here we are measuring risk by way of standard deviation. So the total risk of the stock is getting captured by standard deviation. But then we know that from a portfolio perspective, the total risk of stock is not relevant to me. So I can take out the specific risk of the stock, and that will help the stock get pulled into this line. So what we take is beta on the x-axis, which is basically the measure of systematic risk. So once we filter out the unsystematic risk and simply take systematic risk metric on the x-axis, all the stock would fall in line. All right. So for SML and CML, this is the kind of difference that you should know. For CML, one portfolio, dominant portfolio that would lie on the line is the market portfolio. And all along the line, you basically have combination of the risky portfolio, which is the market portfolio, and the risk-free portfolio. Okay. Now, I think what also should be remembered, and let me just ask you it as part of a quick quiz. What is the slope of CML? What is the slope of the CML better known as? Can you guys tell me? Now we know all the efficient portfolio will lie along the CML. What is the slope of the CML better known as? Sharpe ratio. Absolutely correct. Bang on. Very good. What is the slope of the SML better known as? What is the slope of the SML better known as? Yes. Okay, it's the market risk premium. So that should be RM minus RF by 1 minus 0. All right. But for any particular stock, what shall be the slope? So let's say if I take a stock which has a return of RI, okay, and has a beta of BI, if I need to calculate the slope of this based on this, what will it be? It will be RI minus RF by beta I, which is nothing but the Trenner's ratio, or rather the Trenner measure. All right, so Trenner measure. Okay. So ideally, if all the stocks are well priced, the Trenner ratio should be equal to RM minus RF. All right. So uh, what shall be the equation of an SML? The equation of the SML is nothing but the CAPM. So Ri is equal to RF plus beta into Rm minus Rf. Well, that's what CAPM is, and that's exactly what the equation of SML is. One favorite question of the institute is sometimes they will give you the SML. Okay, it's an easy one. They will give you the SML and they'll say, okay, a stock lies over here. Is it undervalued or overvalued? So you have stock A lying over here, you have stock B lying over here, and you have stock C lying over here. So what would you comment about stock A, B, and C? Yes, stock A would be undervalued, overvalued. Okay, stock A would be undervalued, absolutely correct. C is fairly valued, and B is overvalued. Benjamin, get it right. A will be undervalued, B will be overvalued, and C will be fairly valued. Okay, great, great. I think you got it right. So anything which lies above the SML is undervalued. Anything which lies under the SML is overvalued. That's how we tend to remember. Okay? So anything over the line is undervalued. Anything under the line is overvalued. All right? Yes. Okay. All right. So let me now just, so yeah, that's what I was talking about. CAPM, beta, mispriced stocks. How to identify them? Okay, this again is important, guys. How to assess the performance of the portfolio. There are 4 measures that are included in your syllabus, and you should be very, very clear with this. Sharpe ratio, M square, Trenner measure, Jensen's alpha. Guys, get conversant with all the 4 measures. Okay. Now, the Sharpe ratio and M square takes into account standard deviation in the denominator, while in the case of Trenner and Jensen, the risk that gets adjusted is based on beta. Okay, so here the total risk gets taken into account. Here only the systematic risk would get taken into account. So clearly these will become the appropriate performance measures. These would become the appropriate performance measures in case if I am just vested with that particular portfolio, because then the total risk of the portfolio becomes relevant. But if this portfolio is one of the many portfolios that I'm holding, if this manager is one of the many managers that my assets are invested with, then I think for any single portfolio, I might look at the Trenner measure or Jensen's alpha to get a sense of the risk-adjusted return. All right. So, okay, Nitish has a question. Is beta diversifiable? Well, beta is the coefficient of the non-diversifiable risk. Nitish, beta is the measure of the non-diversifiable risk. But if you were to ask me, can beta be done away with? Well, yes. Can I create a zero beta portfolio? Yes, I can. I can go long some beta assets. I can go short some beta assets. Or I might just want to buy certain assets which might have negative beta. So I can reduce the beta of my portfolio. I can bring it down to 0. But then beta by itself is the measure. Beta with respect to any asset is the measure of the non-diversifiable risk. All right. So economics, I don't know whether we have time enough. So let me just indicate what are the important topics, and you might just want to have a look at them and note it with you. So these are certain things which are important, which I over time through my experience have seen being tested upon very often in the exam. So let me move on. Yes, especially in macro, these are the ones which are important. Okay. In alternative investments, okay, I shall, Sunny. Just a sec, guys. You might just want to take a snapshot of this. Okay. Okay, there we have it. Nitish, maybe I can take your question off the line, or maybe I would answer it. So in alternative investments, guys, be familiar with these. Shall I move on? Next slide. Okay, in the case of hedge fund fees, you do expect a number problem. And this personally, I think, is important, so they might just give you a sense of how the investment is growing, the investment fund which is being managed by a hedge fund. And so how's the management fee, how's the incentive fee being charged? So you might have a couple of number problems in your material. I would strongly insist that you practice it and practice it well, because this is important. Hurdle rate would be on not the initial capital invested, it's going to be based on the initial value of the investment every year. Okay, so it's like beginning of the year value of the investment. Okay, so you might have started off with 100, but at the end of year one, post management fee, incentive fee, if you are left with 110, then for the next year, the hurdle rate would be applied on 110. Okay, for roll yield, okay, now this is, okay, let me just very quickly answer this. Now, in the case of, I mean, all of you should be aware of, okay, so this is a question from Nitish. Roll yield is negative in the case of contango. Well, the answer is yes, if you're long futures, okay? Because in contango, your future rate is greater than the spot rate. So in case if the spot rate remains the same, one would see the future prices coming down to converge with the spot rate. So that will result in a negative roll yield. That's true. Okay, Nitish, I think that answers your question. So if you're long futures, well, there will be, well, that's future rate is greater than the spot rate is the normal case. Absolutely, and that's contango. When the future rate is lower than the spot, that's when it's backwardation. Okay, collateral yield is the return that you would get on the collateral that has been furnished when you buy the futures. So if I have taken futures, and against taking futures, we have to furnish some margin deposit or some collateral, and the kind of yield that I get on that collateral is the collateral yield. And just going back to your question, Nitish, under current account, you would take into consideration the income inflow, or let's say the inflow on account of exports and the outflow on account of imports. While in the case of capital account, we would tend to take investment inflow and investment outflow. So I mean, as the terms suggest. And specifically item-wise, what's going to be the difference, or what is going to be the composition? Maybe it will do good if you could just go through the material. Okay, the pricing of derivative. Tanya asks, what is the role of arbitrage in pricing of derivatives? Well, may I say that the pricing of derivative is based on arbitrage, is based on risk-free arbitrage. The whole idea is that my derivative should be priced as such that it should leave no scope for arbitrage. Okay, so let's say, Tanya, I take a simple example. If my spot price is $100, okay, of the underlying, and I want to get the 1 year forward rate, and when the risk-free rate is, let's say, 10%, my forward price should be $110, nothing less, nothing more. Because if it were to be more, it creates scope for arbitrage. If it were to be less, it again creates an arbitrage situation, isn't it? So the pricing of derivatives is based on the assumption that it should leave no scope for arbitrage profit. All right, I think we're almost there at the end, and it's been great interacting with you guys. I believe it's pretty late now, so all the best. In case if you have questions which have not been answered, I think feel free to mail it across to me. And so my mail ID is amitparak@gmail.com. So in case if I think this will, Ankur would have given you a contact mail ID, but let me do the same. So you could possibly mail it across to him or to me. I will nevertheless get it. So amitparak@gmail.com. So that's my mail ID. I'll try that, Sunny. I think I've given you my mail ID. I will try to see if we can get some mocks for you. But again, my humble request: don't sit for the mocks a day or 2 or 3 days before the exam. I think the last 1 week should simply be spent on looking at the questions, answers, not thinking too much. Okay, so whatever hard work needs to be done, it should be done early on. Okay, great guys. Thanks a lot. It's been wonderful, and I've given you my mail ID. In case if you have any question, feel free to send it across. Good luck. Thank you. Good night.